Hey, everybody. I am here with Michael Scott. My name is Rainah Fitzgerald. I'm the Client Services Specialist. Michael is our CFA, or what we like to call our in-house CFA. So today we're doing a quick Q2, quarter two update about what this past quarters look like for the market and for the economy. Michael is great at getting the word across of what that looks like in simpler terms, at least from what I can understand. So Michael did a recent article for us. You can find that on candorpath.com under our blogs. He wrote this article again for quarter two. But today we're going to kind of look over also what the first half of the year has looked like. So to kind of jump into this, Michael, at the beginning of your intro, you had a really interesting story, and I'd love for you to touch on that just a little bit.
Yeah, good morning, Raina. And it's kind of an interesting story that I was thinking about what's been going on this year and what the second half of the year might look like. And it took me back to this interesting time in November of 2019. I had the opportunity to go to New York and go to a conference at JP Morgan's global headquarters in downtown New York.
Yeah.
And I was getting ready to listen to a presentation, speech, who knows exactly what it is called, but a presentation by Dr. David Kelly, who's the chief global economist at JP Morgan. And we were sitting in this room, and I wear contacts, and I am blind as a bat without my contacts, and it's really bad. So I'm sitting there, and his presentation was something along the lines of like 2020 vision, a guide to the future, or something like that. And as he's getting ready to begin, I just kind of blink and one of my contacts pops out. And now I'm sitting here with one eye open, the other eye kind of closed, kind of blurry, and I can't see what's going on. And it kind of, looking back, is kind of humorous, but also is kind of foreboding to what 2020 turned out to be. We had all these thoughts and visions of what it might be, but we had no idea in November of 2019 what 2020 and even 2021 and where we're at now was going to look like. So it was kind of humorous and foreboding looking back, but it was also kind of a similar situation today when I think we've talked about it before and talked about it with John and Matt. What 2022 looked like. Start of the year, we thought everything would be very positive. Now we're sitting here and it's not as good, but what is the second half of the year going to look like? So it's kind of an interesting parallel, that blurry vision moving forward.
Yeah, so obviously we'll touch on kind of what the second half of the year could look like too. But how interesting that your contact lens could also be like you said, foreboding in a way of like what it's looking like now, what 2020 looks like. So it's super interesting. I love the way that you framed that. And I remember reading it and being like, Michael, it's such a hook, line, and sinker. It's like just like what they told us in elementary school, like how you should start your articles. Like I was hooked after that. So thanks for that. And thanks for sharing that story. So to talk a little bit more about it, can you give us some details on what this first half of the year has looked like for us?
Yeah. So the first half of the year, I think for most investors, has kind of been uncomfortable. Well, let's just put it out there. It's been uncomfortable for everybody. And that's because historically, when stocks go up, bonds will hopefully stay flat or go down a little bit. But when stocks go down, we want our bonds to hold us up, and that's not what happened this year. So far through the end of June, the S&P 500 was down about 20%. The NASDAQ, which is your more tech-heavy, pricier index, that was down more than 20. The Dow Jones, that index you always see cited on TV, the market was up 100 or down 100 points. That index was down a little bit less than 20%. So overall, not a great start to the year in the equity markets, but what was really uncomfortable, I think, for most investors is that their bonds didn't do well either. So through the end of June, the aggregate bond index was down 10%. And it kind of makes sense when we think about it, because to start the year, interest rates, and we throw out, because there's multiple of them, the 10-year treasury is one, went from 1.6% at the beginning of the year to about 3% on June 30th. And if we remember, when interest rates go up, bond prices go down. So not only did you lose money in stocks this year, you lost value in stocks this year, but your bonds didn't behave the way we want bonds to behave when stocks go down. And you pair that with a little bit of inflation, and we sit here and thinking, wow, there's not really a good place to go anywhere. You can't be in cash, can't be in bonds, can't be in stocks. So it's uncomfortable. And about kind of the only things that seem to have went up this year was interest rates, inflation, and home prices. But even now, home prices seem to be slowing a little bit. So it's kind of an interesting position to start the year.
Mm-hmm. Yeah, for sure. So to segue right into it, what is this second half of the year? What does that look like for us as investors?
Yeah, and to set the stage for the second half of the year and to really see where that's going, we have to kind of understand what the current environment we're in is at. And currently, it's funny going back to that introduction of 2019 when we go back into or to talk about the roots of the reason why we're at the position that we're at with both stocks and bonds being down this year. It really comes back to our response from the 2020 COVID crisis. So coming in out of the shutdown in 2020, where almost the entire country was shut down for 8 to 12 weeks and slowly reopening, we put all these different programs into place. And if you remember back, there was like the PPP, the Payroll Protection Program, the stimulus checks, what we called economic impact payments. And there were a bunch of other programs that were put out that basically tried to hold the economy up. It gave consumers money to spend. And it gave businesses money to spend or took away some of their expenses. And this put together almost a perfect storm. And through economic crises, we learn things from the past. So from the great financial crisis, we learned that we need to keep the consumer healthy, keep the consumer spending. We need to keep jobs in place. It's a lot bigger of a hole to dig out of if those things aren't there. So all these programs were put in place to protect consumers and protect businesses. So what that did was give all of us money to spend. And as Americans, we spend our money. Now,
Mm-hmm.
that would all be normally good and fine. The problem here was that when we moved into 2021, the supply chain issues persisted and caused a problem. So all of us had money. We all wanted to spend initially on goods. So we bought Pelotons, we bought new clothes, we bought cars till there were no more on the lots.
Mm-hmm.
And there was a lot of dollars chasing not a lot of goods. And eventually that switched over to services as well. So once we were able to go to concerts, once we were able to go to sporting events, once we were able to do all that, travel, we began spending money on airplane tickets as soon as we could. And this kind of led to a perfect storm of increasing prices along the way. We led to this inflation because we had so much money to spend and we wanted to spend it because we're Americans, it's what we do.
Mm-hmm.
And that kind of led to the inflationary aspect that we're seeing. And to fight inflation, the Federal Reserve wants to hike interest rates, which you raise interest rates, you hurt bonds, and it can also cause problems in the equity market. So that's kind of where we got to today and the roots coming back from this 2020 crisis. And when we think about where we want to go in the future, um, it's still a little blurry, but there's a lot of things to be excited about. And a couple of them first, even though we're seeing high inflation, um, consumers seem willing and able to absorb it in a lot of ways. So we talk about airline tickets. You know, airlines are very expensive right now to fly on relative to what they were a year ago, even pre-COVID. But the actual amount of people going through TSA security lines is about the same as what it was in 2019.
Yeah.
So people are absorbing these prices in different ways. And when we think about the economy as a whole, though we have our headwinds currently, there are about twice as many jobs available to people that are looking for jobs. So if you're someone who needs a job or wants a job or you want to switch jobs, it's still very advantageous for you to go get a job, which means that the consumers are probably going to remain healthy for a period of time. And over the past couple of years, one of the things that we think about or we forget about a little bit um, is that interest rates were lowered for the past 2 years. So if you're a homeowner or you bought a home in the past 2 years, chances are you bought a home at historically low interest rates or refinanced at historically low interest rates.
Mm-hmm.
So even though some of your expenses may have gone up, you might have dropped your mortgage expense $100 or $200 if you refinanced. And that's playing a bigger role in allowing people to spend money.
Mm-hmm.
So we do think that there are headwinds on the market, there are headwinds in the economy, but it's not all bad. There are things to be happy about or confident about, and we're seeing companies report earnings right now, and a lot of companies are doing well. So we'll pump the brakes and see what happens for this next couple weeks, this next couple months. But there's no reason necessarily to throw in the towel and say everything's bad at the moment.
Yeah, absolutely. So, changing perspective, kind of zooming in a little bit, what does that mean for our clients and our investors for their portfolios? How should we be positioning that and looking at that?
Yep. So it's a very good question. And the first thing I'll say is, everyone's situation is different, right? And the number one thing you want to do when you talk about this is check with your advisor. Or if you don't have an advisor, look into finding one, right? But for our clients specifically, when we look at what we should do for our clients, we still believe a diversified portfolio approach makes sense for most people. We still think that over the long run, stocks outperform inflation. And we still think that that is a good place for people to be, even though they haven't performed well year to date. And at this point, um, everything can always go lower, right? But it's a great, attractive entry point. If you are a long term investor, you can buy things at a discounted value relative to where they were a couple months ago. And even though we see inflation going up and interest rates have gone up, a diversified portfolio has bonds in it, and you still need to own bonds too. We think that the right mix for the right individual, their specific mix, still makes the most sense, and that's still where we want to position clients moving forward.
Yeah, absolutely. Well, thanks, Michael, so much for talking more about this, giving us a better perspective and a very logical perspective, too. I think, our emotions can get the best of us sometimes. And like you said, we can feel like we want to just throw in the towel. But I think there's a lot to look forward to. I learned a ton. And if, like we said, you would like to see this article, you'd like to read it yourself, again, that's on candorpath.com under our blogs. This was just kind of a quick snippet video talking more about it, chatting more about it. So if you have questions, obviously leave them in the comments, reach out to your advisor. We're always here to help. So thanks again, Michael. We really appreciate you and have a great day.